Ira Epstein of Linn Associates with your Tuesday agriculture wrap-up, and this is for August 6, 2019 at 3:55 p.m. Central Daylight Time. The grain markets were primarily lower today. Obviously, they're still feeling some of the impact of the U.S.-Chinese escalation of the trade war, but we also had some good rains throughout the Midwest, and that put some pressure on the corn and the bean market. Wheat's sort of that whipsaw that you get back and forth right now. You still got energy prices falling, and you did have a bounce today in the gold, in the stock indices. I was pointing to the stock indices and I said gold, but gold caught my attention because it's nearing the high of the day in the last 5 minutes of trade. It won't close there, but that's a pretty good action, and we're seeing a mixed bag in the foreign currency market. Now, as you can see, we're still in this corrective mode on a weekly area chart of just closing prices in the Nove beans. For the week, though, we're pretty unchanged. You're down 2.5 cents, so the first 2 days of the week haven't produced much there. This downtrend line is still in existence, and it comes in around the 890 level, which is about 25 cents higher in the bean market. When I put on the swing line, I now have a pattern of a lower low, and with the outside day up yesterday, a higher high. Now, the one thing you don't want to see taken out is the lows that we made yesterday at 854.5, purely because we had what I call an outside day up, and if you're going to create a bull trap, as I define it, you don't take out the low of an outside day up within the next two trading sessions. If you do, I'll show you what I look for. In terms of momentum, you can see that the 18-day average of closes did get under the 100-day, and that happened right around here, which was last Friday, and the market has made a new low off that move, and now it's what I'll call in a bit of a pause. You can see where the Bollinger Band is, so my problem with the market is if you take out this 854.5, I'm not quite certain what the next downside would be in the market other than going back to these old lows, probably in the 820s, 830s. So that could be a zone that you look at. More important to me is that the market did move to the right-hand side of the Bollinger Band, not trending. It's got downside bias, and the market is embedded. Embedded is the danger. Embedded means that you convert the momentum called a slow stochastic from being oversold to locking in sideways. And when that happens under the number 20, what I define it as is the word embedded or locked in. And it takes 3 days in a row to do that, and you've certainly got those. In fact, today was the 4th day. So that keeps this market under pressure. Now, here's the good news and the bad news. That means that the market keeps getting sold on the rallies until the red line closes back over 20. On the other hand, if it closes over 20, it's called losing the embedded reading. If you lose it, it often puts price and the closest of the main moving average, the 100 of the 18-day average, on a trajectory towards and possibly hitting each other. So, interesting time, but still the bears have control of this market. In the meal market, if you look at the slow stochastic reading, you lost an embedded reading. Now let's double check. You can see yesterday, which was Monday, both numbers under 20, both under 20 on Friday, both under 20 on Thursday, both under 20 on Wednesday. I can go on and on. It doesn't matter. You lost that reading today. When you lose that reading, as I just said, it puts price in the closest of these main moving averages, the red one, which is the 18-day, on line for each other. There's one thing you have to keep in the back of your mind. Losing it means you have to keep it lost the day after it's lost, which is tomorrow. Now, because the market closed in the top part of the day's range, even a steady opening is going to jump. The way the math works on slow stochastics, that number probably into the mid-20s. Take a look at it tonight. If it can do that and not fall back down and re-embed, then I'm going to look for price in the 18-day average to come together. I'm wrong on that thinking. People have asked me where you're wrong. Under the most recent low, when you get that in losing of an embedded reading. In the soy oil, lower highs, lower lows. If you look at today's low, 27.54 was under 27.60. You're on line to hit again the lower Bollinger Band. Now here's an interesting part. When you get a market that hits a Bollinger Band, it's like a pinball machine. The neutral numbers, the 18-day average, shouldn't get back there, and it's sort of like a pinball that you have a reset button on if you've ever played one. I'm obviously got gray hair. I love that machine. And the market ran up to both the 18 and the 100-day, started breaking back yesterday. Now it's just shy here of hitting that lower Bollinger Band. If it hits it again, I'll go through the process again, that the market might go back and run into that resistance number. I would look for the pros to come out against that lower Bollinger Band. In the corn market, the 100-day average, the number you would slice through on this way down, when you leave it and you go down, on the way back up, often what could have been a support area, because you did hit it and stall, becomes something of a resistance zone, and that's pretty much what this market's doing. The good news for the corn bulls is you've lost the embedded reading. Now, my only goal, and what have I said? When you lose it, it's the closest of the main moving average. So you've hit that number. If you get extension, then the 18-day comes into play, but you have hit the first upside target off this bounce. In the wheat market, you still have a pattern of lower highs, lower lows. This market is still bearish. I think the pros were waiting for the market up against the 18-day average. It didn't quite hit it. It missed it by a penny, and you can see the reversal back down. You're no longer in an oversold condition. You're just in a downtrend, downside bias in a market that's had a correction in momentum. In the sugar market, down another 9 for the day. The battleground has been, for 2 weeks now, this 18-day average of closes. If the market clears 1169, you put into play the potential for the lower Bollinger Band. On rallies, the resistance is still the 18-day average, but it's not trending. You have the pattern of a higher high and a lower low. You have downside momentum, and bias remains to the downside. Coffee's just been leaking away. Now, one of these days you're going to get a correction in the market, and when it comes, you've really taken the market down hard. It can be a very short, sweet correction. Playing for it, forget it. The market is still in a bear trend. When you lose the embedded reading, I'd get nervous. Until then, on these rallies, the 100-day average might offer the first resistance point, and I think the pros will be willing to sell it as long as you have the embedded reading in place. Lose that red line, get it over 20, then that 18, first the 100-day average becomes an objective, and if you clear that, you might be going back to the 18. There's still nothing long-term friendly on that chart, nor is there in cocoa. Look at how the soft commodities have just fallen literally apart. The hardest thing when you get a trade on like this is riding it, because each day it's just a grind. Another $560, you were 56 points lower today, and it just keeps eating everybody that's long above the market going, well, it's got to bounce. Nothing has to bounce. I've been around this 5 decades. I've seen things go in crazy manners. You know, when I was really young, and I'm dating myself, I think I watched potatoes at that time trade limit 20 days in a row. Now think about what I'm saying. That's almost a full business month. And I was new in the business, and I'm going, potatoes. After that, need I say that the contract went away, but if you were in the wrong side, it was a limit move consistently. Why even come to work? In the cotton market, lower highs, lower lows, 3 days in a row under the lower Bollinger Band in an oversold market. So this is a market ripe for a bounce of some type to get back to the right-hand side of the Bollinger Band, but it is not a market that's ready, at least on the chart, to change trend. It's a market that's oversold and might want to correct a bit. Cattle market reinstated its bear trend, lower highs, lower lows. It was a breakout to the downside yesterday, and it's not showing any sign of giving that up. If it decides to roll here, be careful. This is because of the sideways action. It can pick up momentum on you. Admittedly, the market is knocking on the door of getting oversold. I consider any reading in the slow stochastics under 30 as entering oversold territory. Oversold is just that word. It's oversold. It's a filter maybe where certain traders aren't adding to a position, but the trend is down, the bias is down. So at this point, I'd be thinking what the bears are doing. In the feeder cattle, the market continues to respect this lower Bollinger Band, unlike what the fat cattle is doing. Remember, these are younger animals that are going to be fattened up for the dinner table. And you've got the higher highs, the lower lows, the sideways mode, a difficult market, and the hog market is just still bearish. Lower highs, lower lows. All that this correction did the other day is it moved you back to the right-hand side of the Bollinger Band, and you're hugging still this number. Now, you are oversold. I think pros did take some money off the table in this general area, but that's all they've done. Is there a reason to be bullish other than the market's oversold? I don't have it for you. One of the features that we offer here is something called Chart of the Day, and let me explain this. We send one out every day of the week. And in this, we give you our proprietary study called a price count. Now, think of this like a Fibonacci number or something of that nature with a swing line combination. You're looking for a pattern that sets up a bottom, and from there, if you start rallying, where might the market go? Or from a top area, if you start breaking, where might a market go? So what we do is we cover the whole spectrum of futures in this. We send one each day, and it's free to you. Give us a call. You can go to our website, www.iraepstein.com. You'll see our carousel of free offers. Click on it. You'll see Chart of the Day. Sign up. We'll be certain to get that to you and any other offer that you want there. You can also click here. If you're watching me on YouTube, it'll take you right there. I'm Ira Epstein. Have a good day.